So, of course, valuation of inventories is not completed here, but you would have introduced the topic and you would have done something with your own hands. And same with cash flow statement, you would have done at the end of this session something with your own hands, right? So, what is inventory? We know inventory is that part of goods purchased or manufactured that remains unsold, right? That remains unsold. So that's still lying with us. Now, what are the types of inventory? For service business as it is, we have very little inventories. For product business, we really have lots of inventories, right? When you are selling some product. And within that also, there are two possibilities broadly. One is you are a trader. You are a trader. You sell what you buy. So you are actually buying finished goods and then you are selling them. You are buying finished goods and you are selling them, right? In our basic example, we said, let us say we are selling pants and shirts in the most basic example. Then we said pants and shirts is what we said. So whatever is unsold is our inventory, right? And that was when we are a trader. What if we are a manufacturer? So then we are not, of course we are selling pants and shirts, but we are not buying pants and shirts per se. We are buying clothes. हम सिर्फ थान से कपड़ा खरीद रहे हैं. We are just buying clean clothes. And then we have a few tailors who are stitching pants and shirts, which we are selling, right? So what do we need for these tailors? We of course need some sewing machines. In the basic example, we need needles and threads. Then we need, then we buy them, which is the plain cloth. The plain cloth is called as the raw material. Then in addition to that, at the end of the year, we would have manufactured some completely and sold many of them. Whatever is not sold, fully ready pants and shirts, that is still lying with us is called as finished goods. In addition, there will be some that are partly completed, right? As in, we have cut it, the stitching is on, maybe the shirt is almost ready, but the collar is not yet ready, the buttons are not yet put, so all these things, right? So these are work in progress, right? So, and then of course we will have some inventory of buttons, some collar suit and other stuff, needles, threads. So that is our spares. So what the example that I gave just now for plain clothes, just to make it simpler, the same thing applies. This is an example given for a steel industry. If you are a trading firm in the steel industry, the finished inventory will comprise of steel products which are kept in your warehouses. And what will be the raw material? Raw material will be iron ore, limestone and coal. Work in progress inventory will be molten metal and steel slabs. That's work in progress. Finished goods will be cold rolled steel in stockyards. And stores and spares are stationaries, bearings, grease, etc. You got what I am saying? Because that was much easier to understand, right? If you don't have knowledge of steel industry, at least in the previous example you have understood what is it that we are, what is raw material, what is work in progress, what is finished goods and what is spares. Yeah. Next. So when we are talking of inventory, why is inventory valuation important? Why is inventory valuation important? See, remember the most basics. The most basic form of profit and loss account, sales minus cost of goods sold, is gross profit minus expenses, right? And whatever things that you buy, when you value them, that will, for the things that are sold, they will go, of course sales में तो जाएगा ही, but for the things that are sold, that will go under cost of goods sold, and for the things that are unsold, they will remain with you as inventory in your balance sheet. If it is sold, it will go to your profit and loss account under cost of goods sold, and if it is unsold, it will remain with you as inventory in your balance sheet. So, how you value impacts both the cost of goods sold and therefore your profit. If the valuation is high, then cost of goods sold will be high and profit will be low. If the valuation is low, then cost of goods sold will be low and profit will be high. So how you value inventory impacts your profitability. So it's impacting your profit and loss account. Again, since inventory is also sitting in your balance sheet, therefore it will impact your balance sheet also. For the ascertainment of income, it is only the cost of goods sold that should be charged against revenue, right? And why is that? Let's go back to day 1 and 2. Day 1 and 2, we said periodicity concept. What was periodicity concept?
Accounting period.
Accounting period. So we, for the purpose of accounting, we come up with artificial time periods in which we do our accounting. In India, the artificial time period as given by government from an annual perspective is 1st of April to 31st of March as given by government. So we will do accounting for the period of 1st of April to 31st of March when we prepare our annual accounts. If you are preparing monthly account, you can do April, May, June. If you are doing quarterly, you will do April to June, July to September, October to December, and so on. And so that was the first. And what was the second thing that I mentioned? From day 1 and 2, you may remember the matching principle. What was the matching principle?
All the expenses
Assets कहाँ से आ गया?
all the expenses and all the profits of same year.
Not profits, revenues are matched with cost of the related cost. All costs are matched against revenues, and only those costs that are relevant for the purpose of generating revenues will be considered. So, for the ascertainment of income, it is only the cost of goods sold that should be charged against revenue. That's the matching principle. You remember that? Matching. सारे cost नहीं डालने हैं. You bought goods worth 10 lakh rupees. You only sold goods worth 1 lakh rupees. So against this sale of 1 lakh, what was the proportionate cost? It was, let us say, 80,000 only. So you will charge as cost of goods sold only that proportionate part that you have sold. If you have not sold, then you will not charge it. Are you all clear? So not all the goods purchased or produced during the year are sold. So what is remaining with us is our inventory. And how do we value inventory? For valuing inventory, we will have, there are many methods, but for the purpose of this course, we will have 4 methods. First in, first out method, last in, first out, weighted average and specific identification. What is first in, first out? First in, first out. First in, first out means the goods that came in first were sold first. Last in, first out is the goods that came in last are sold first. Weighted average is just take the average of costs and arrive at the value. Specific identification is, okay, this is that particular, if there are 20 phones that you are selling, this particular phone, you identify the cost of this phone is 80,000, the selling price is 90,000, the profit is 90 minus 80, 10,000. That is specifically identified. So, the simplest example, let's start with a simple example. Let us say this jug, yeah, this jug. We bought two such jugs. Two. First jug we bought at 10 rupees. Second jug we bought at 20 rupees. First jug we bought at 10 rupees. Second jug we bought at 20 rupees. So let's write it down. We bought two jugs. First jug rupees 10. Second jug rupees 20. And then we sold one jug. And we are not specifying which jug. Huh? We sold one jug. If we sold one jug, let us say, what is FIFO method saying? First in, first out. We don't know which jug is sold. But if we are following FIFO method, we are saying first in, first out. So the first jug that came in is sold first. The second jug is not yet sold, it is lying with us. First in, first out for the point of selling. So the first jug, if we are talking about FIFO method, yeah, then let's talk of FIFO method. So in FIFO, first jug 10 rupees, this is what we sold, right? And the first in, first out. So it means cost of goods sold is how much? 10 rupees. Second jug is not sold. It is still lying with us. So what is the value of inventory? 20. The value of inventory is 20. This is cost of goods sold 10, yeah? You can see it, right?
Yes, sir.
So under FIFO, cost of goods sold is 10 and inventory is 20. So, and what will happen under LIFO? Under LIFO, what is LIFO? Last in, first out. So, whatever came in last is sold first. Which came in last? First or second one? Second one. So, this is sold. So, if this is sold, second one is sold, which means cost of goods sold is how much? 20. Right? Cost of goods sold is 20. And which one is lying with us? The first one. So, how much is inventory? This is lying with us. So, inventory is 10. So, do you see the difference in the two methods? Under FIFO, first one is sold and second is with us. So, sold is at 10 rupees, COGS 10, cost of goods sold, inventory 20. Under LIFO, reverse is there. The second one is sold, last in, first out. So, this one is sold, so cost of goods sold is 20, inventory is 10. So, under FIFO, you will see profit. Cost of goods sold is 10 rupees. Cost is low. Then profit is high or low?
High.
Because cost is low. So profit is high. Under LIFO, cost of goods sold is 20. So cost is high, right? Relatively. We are talking about relatively. So profit is low. And what about balance sheet? Balance sheet, inventory is valued at 20 rupees. So balance sheet is strong because we are showing more assets. Are you seeing that? Because the value of asset is there, more. Here the balance sheet is relatively, we are talking about relatively, yeah? Relatively, balance sheet is weak. Relatively, yeah? Because the inventory is only worth 10 rupees. Here the inventory is worth 20 rupees. Are you getting the point? So how cost of goods sold is impacting, lower cost of goods sold is resulting in high profit, higher inventory is resulting in high value, stronger balance sheet. And therefore, cost of goods sold is high, so profit is low, but inventory is valued at a lower, and so balance sheet is relatively weaker. Are you getting it? And why is this happening? This is happening because we are in an inflationary situation. Do you see the inflation here? The first jug was bought at 10 rupees, the second jug was bought at 20 rupees. So this is the scenario, but this scenario plays out in inflation, which is the more likely scenario, right? Because almost always we see inflation. What if we don't have inflation but deflation, ulta ho gaya, then we will, exactly opposite things will happen. I only showed the inflation scenario. Are you all clear on that part? Okay. So let us now understand. I have already explained the basics. You have understood the basics. Now let's next. Methods of inventory valuation. So the four methods only. First in first out method. It's based on actual cost. You saw that, right? We took the actual cost of this, like whether 10 or 20, we took the actual cost. Whether 10 or 20 is a separate issue. Goods received first are issued or sold first. We saw that. And closing stock consists of goods or material purchased recently, more recently. While under D4, method of valuation is again based on actual cost. Goods purchased most recent are assumed to be sold first, and the goods that were closing stock consists of goods or materials that were purchased earlier. Clear? Before we come to weighted average, we will go to specific identification. Because under specific identification, we will actually identify whether whether the first jug was sold or the second jug was sold. And depending on which jug was sold, we will go with their cost of goods sold, we will go with their inventory valuation method. Are you getting it? All three methods up till now, except weighted average, is based on the actual cost. See, every time we have taken the actual cost. If it was 10 rupees, then we took 10. If it was 20 rupees, we took 20. So we have taken the actual cost of the material sold or goods sold for the purpose of calculating cost of goods sold and for the purpose of calculating the value of inventory. Right? The fourth method is called as the weighted average cost, and this does not take the actual cost into account. What this does is something simply, it will say weighted average. In this case, it will be a simple average for a different reason, as you can see. We got two items. What is the average cost? 15 rupees. Weighted average cost is 15. Because the reason weighted average is same as simple average is because 1 is to 1. Therefore, weights are equal. Therefore, weighted average is same as simple average. Right? If it was 1 jug of 10 and 2 jugs of 20, then it would be 16.67. Right? So here in this case, cost of goods sold, one was sold 15, inventory, one is with you 15, profit is somewhere in the middle, compared to the other two, profit is somewhere in the middle, and balance sheet situation is also in the middle, right? I am writing just to denote that it is in the middle, right? Just as a, otherwise here you have seen profit was up, balance sheet is strong, profit is down, balance sheet is weak. Here it's in the middle, somewhere, right? So everyone, let's take your pen and paper out. Next. Now, in the other class, maybe you also asked for it. I don't remember. I remember C specifically requesting when I saw their informal feedback in this class में थोड़ा कराओ. So चलो करो. Let me summarize the problem for you so that you understand it. Question is saying, this is the scenario. See, these are alternate months. April, 2 months later June, 2 months later August, 2 months later October, 2 months later December. These are alternate months. But how many bottles are purchased? 200, 200, 200, 200, 200. What is the price per bottle? 2, 4, 6, 8, 10. How many bottles? So every month, basically every alternate month, we are buying 200 bottles. But it's an inflationary scenario. Do you see the inflation?
Yes.
Price rises by 2 rupees every 2 months. 2, 4, 6, 8, 10. and एकदम uniform buying over 5 months, right? 200, 200, 200, 200, 200. How many were sold? First 2 months we sold 100 each, next 2 months we sold 150 each, and last month we sold 400. So the question is understood. Now the data is understood. Question is calculate the cost of goods sold and calculate the value of inventory using LIFO and FIFO. That's the question, right? So how do you calculate it? First prepare the format of a table like this. Right? Don't go with your book. Your book is a bit complicated. Don't go with your book. Do it this way. So first you write LIFO on top. That first we will calculate LIFO, then we will calculate FIFO. For LIFO, I have done only for 3 months. You should do for all 5 months. First header is the month or date or month: April, June, August, October, December. Then you should show purchase. How many you will purchase? Then you should show sale. That's actually you are showing cost of goods sold. So I have written sold, but cost of goods sold. Finally, what is the ending inventory? And finally, I have written a remark which is important for you to understand how to calculate. So let me show how to do it. So, but everyone must prepare this table, right? Everyone must prepare this table, and if you are on laptop on अब बंद कर दो सर, so ये हाथ से ही करो. You don't need it for next 10 minutes. So, has everyone prepared this table? You really don't read the remarks. Remarks is only for me to explain. You only need this. And दिख रहा है? अच्छा. बड़ा करो. उसका थोड़ा बड़ा करो. हाँ. हाँ this part. को बड़ी responsibility है. This is better? Windows के left right करो. So don't look at me, right? So question is understood. 200 bottles for 5 months, 2, 4, 6, 8, 10 price. How many did we sell? 100 for first 2 months, 150 for next 2 months, 400 in the last one. So overall we bought 1000 bottles in 5 months. We sold 900, we are left with 100. That's the essence. Right? So I have only done it for 3 months because you should do the balance 2 months, and in anyways balance 2 months table is also good. So it's not there, it's not there. So let's do for April. How many did we purchase? We purchased 200 bottles, price was 2, right? So purchase was 200 at 2, which is 400. Quantity, price, amount, right? I just written together instead of 3. Yeah? This is much easier to write, right? 200 at 2. Sale calls is how much? Out of this, how many were sold? 100 were sold. In April, we don't have anything else. First month hai. So whatever was purchased has been sold. So 100 is sold. That is clear from the problem. But at what price? 2 rupees. Although there is no other option for April. So 100 is sold at 2. So cost of goods sold is 100 at 2, 200. What is the ending inventory in April? We bought 200. We sold 100. So we are left with 200 minus 100, which is equal to 100. Right? How much is the ending inventory? 200 purchased, 100 sold. So 200 minus 100, we are left with 100. What is the price? In April, there is no other price involved, only 2 rupees. So the ending inventory is 100 at 2, which is 200. Clear? So April is very simple. Let's look at June. Now look at this comment first. How shall we do it in June? In LIFO, sale is done. What is LIFO? Last in first out. So sale is done first from the latest purchase. Sale is done from the latest purchase column, and then from the ending inventory. Because ending inventory represents previous purchase, while latest purchase is of the current month. Are we clear? So let's do, then we will realize. So how much did we buy? We bought 200 bottles in June at what price? 4. So how much did we purchase? 200 at 4, equal to 800. How much did we sell? 100. So you sold 100. But this 100 that we have sold, will it be from this 200 or will it be from the previous month's inventory? From June itself. Are we clear? Last in, first out. The question is, this 100 bottles sold. These 100 bottles, were they sold from the latest purchase of June, or were they sold from the previous stock that we had in hand? Because the name itself is therefore last in, first out. So the thing that came in last was sold first. So what came in last? Whether the June came in last or whether April came in last? June came in last. So when June came in last, this 100 was sold from this one. So this is 200 at 4. So you have sold 100 at 4 from this 200. This 100 at 4 because we have sold 100 at 4 from this 200. Right? Are you all clear?
Yes.
So 400 is the cost of goods sold. If this is the case, then how much are we left with? We started with 100 at 2. On 1st of June we started with 100 at 2. So 100 at 2 is still originally with us. In addition to that, this month we bought 200, sold 100, so we are still left with 100 at 4. We had 200, we sold 100, but we are still left with 100. So 100 at 4 out of this is also there. So effectively for June, our inventory is 100 at 2 coming from April and 100 at 4 coming from June. Are we all clear? So our total ending inventory is 600. 100 at 2 equal to 200, 100 at 4 equal to 400, total is 600. Are you seeing that? Anyone who is not clear? छोटू सा क्वेश्चन आ सकता है एग्जाम में, you never know, right? You know me very well. कहाँ से मैं दे दूँगा, right? And I can say this we have done it, thus you never know. I have not yet set the question paper, but you know where the questions will come from, right? You are very experienced people now. Yeah. So this is done. So the point is, now look at the key point. The point, now look at, sale is done from the latest purchase column and then from the ending entry. So when we sell here, notice this keyword. When we sell this 100 is coming first from this and then from the ending inventory. This 100 that we sell is coming first from purchase and thereafter from ending inventory, which means we were selling 100. What if we had sold 300, let us say, or 250? If we had sold 250, we would take first these 200 and then we will say for balance we will come take from there. If we had sold 250, we would have taken 250, first take 200 from our purchase and then take balance 50 from our ending inventory. Are you getting it? We have sold 100. What if we had purchased only 10? If we had purchased only 10, then we will say 100 are sold. So first 10 we will sell from here and the balance 90 we will sell from here. Are we all clear? So that's what I am saying. When we sell, we will sell first from the purchase column and then from the previous ending inventory balance. Everyone clear? Clear now? So this is what is happening in NFO. Sale is done first from latest purchase column, then from ending inventory. So what happened so we are left with this. What happened in August? In August, 200 bottles were purchased again, but the price is 6. So purchase August 200 at 6. How much? 1200. This is simple. The question is how many did we sell? 150. If we sold 150, will they come from this or will they come from previous inventory?
August.
From August. So we sold 150 from August. So 150 at 6 equal to 900. and the previous inventory still remains with us. So we still have 100 at 2, 200, 100 at 4, 400, and from August we have 200 purchased, 150 sold, so we are still left with 50. 200 minus 150 is still with us. So 200 minus 150, 58.6 is still with us. Are you seeing that ending inventory? Are you all clear?
Yes.
Amisha, you are clear? Anyone not clear? Simple, right? So now I have done up to August. Now after 2-3 minutes, you will have I will give you 5 minutes. Leave some space for October and December. थोड़ा space छोड़ दो. And then let's also do FIFO first. And then I will give you 5 minutes to complete your other things, right? So FIFO में what's happening? First line is same. April में how much did you buy? 200 at 2, 400. How much did we sell? 100 at 2, 200. How much is lying with us? 100 at 2, 200. Since in the first month you might notice, in the first month, for LIFO and for FIFO, it's the same. For first month, notice it, or also do it. For the first month, LIFO and FIFO are the same. Have you noticed it?
Yes, sir.
Everyone prepare the table, start. Then look, कर रहे हो ना?
बाद में जो लेफ्ट है अप्रैल का अपन ने 100 सोल्ड कर दिया तो 100 लेफ्ट हो जाता है तो वापस जून में अपन मतलब लाइक 100 सेल कर रहे हैं तो वापस वो 100 लेफ्ट हो जाते हैं तो वो 100 ऐड कर दिया.
Then you ask your question. Let me complete these two rows, then you ask your question. You would understand. By the time I complete it, your question will be answered. So first row is clear, right? June. How much did we buy? 200 at 4. June, how much did we buy? 200 at 4. So 800 is bought, right? Sell. In FIFO, in LIFO, we are saying sell करेंगे तो पहले latest purchase से करेंगे and बाद में ending inventory से करेंगे. That's what you are doing in LIFO. But in FIFO, when we sell, we will sell not from the latest purchase. We will sell first from the ending inventory of previous month. Ending inventory of previous month was 100 at 2. How many have we sold this month? 100. So we will sell 100 at 2 and not from this inventory. So we will sell from the original ending inventory of the previous month. So first in, first out. Ending inventory of previous month came in first. Purchase of June came in later. Ending inventory of April came in first. Purchase of June came in later. First in, first out. Therefore, 100 at 2, which is this ending inventory of previous month. So we are selling from the ending inventory first and then from this purchase. Here we were selling first from this purchase and if required from the ending inventory, and that's the key difference. In before we were selling first from the latest purchase of this month and then if required from the ending inventory. In FIFO we will sell 100 first from the ending inventory and then if required from the latest purchase. You got that point? So this is the essence of FIFO and FIFO. So 100 is sold at 2 and everyone is writing with their own hands. Everyone, you are writing? So 102, 200, and if 102 is sold, this entire 102 is sold, how much are we left with? This entire 102 of ending inventory is sold. How much are we left with? 204 is what we are left with. Are we all clear? So 204 is 800. So in FIFO, sale is done first from the ending inventory and then from the latest purchase. And finally, August, how much did we buy? 200 at 6, 1200. How many did we sell? 150. So this 150 is sold from the latest purchase of August or from the previous stock of June? June? This 150 is sold not from the latest stock of latest purchase of August, but from the previous purchase of from the previous stock or inventory of June. So 150 is at 4. This 4. Got it? Na? And 200 at 6 you have. So out of 200, 150 is sold. Look at the inventory now. Out of 200, 150 is sold. So you are still left with 50 at 4. And this 200 at 6 we still have. So at the end of August, if you see the value of inventory, at the end of August, the inventory value is 1200 plus 200, 1400. Here it's 300, 400, 200, 900. We already have a difference of 500. So if the ending inventory is 500 more, let's look at the cost of goods sold. 600, 200, 200 and the FIFO, 1000. Here the cost of goods sold is 1500, right? 900, 400, 200. So where is the profit more? Cost of goods sold is 1000 here, 1500 in FIFO. Therefore profit is higher in FIFO by 500. You can see that? Profit is higher in FIFO because cost of goods sold is lower. And by the way, so I have done up to August, now do October and December yourself. So at the end of it, look at what are we getting under LIFO. See, under LIFO the cost of goods sold is 3100 plus 1200 plus 900 plus 400 plus 200. 43, 52, 56, 58. Under LIFO, after all 5 months, the cost of goods sold is 5800. Under FIFO, the cost of goods sold is 5000. So under LIFO, the cost of goods sold is higher by 800, from 5800 to 5000. So our profit is higher in FIFO by 800. Then what is the value of inventory? The value of inventory under LIFO, ending inventory is how much? 100 bottles. And this is 100 bottles. For LIFO, the value is 100 bottles at 2 rupees. 200. Under FIFO, 100 bottles at 10 rupees. 1000. So the difference is again 800. We see that the difference of ending inventory and the difference of cost of goods sold is equal. The difference of ending inventory and the difference of cost of goods sold is equal. Here the ending inventory is 1000 and only 5000 rupees is charged to cost of goods sold. But here the ending inventory is 200 and 5800 was charged. What was the total one? Total was 6000, of which 200 is put under ending inventory and 5800 under cost of goods sold. Here also the same 6000 is put as 5000 under cost of goods sold and 1000 under ending inventory. Are you seeing that the differences are equal for cost of goods sold and ending inventory? And are you also noticing that depending on the method, it is possible to show higher profits or lower profits by choosing the method of inventory valuation. Okay? This is partly important for tomorrow's lecture because I don't know what you will cover, but you should, same you can imagine for depreciation also, that depending on the method of depreciation used, for some years, for example, straight line will give equal depreciation over the entire life, but double declining balance method will give more depreciation in initial years and less depreciation in later years. More depreciation in initial years means more expense means less profit. Less depreciation in later years means
More profit.
less expense and therefore more profit. Are we all clear? Everyone clear, right?
Yes, sir.
So we will come back to inventories again next week. But for today, I thought let us just do one more topic, which is introduce the cash flow statement. Day one, we took some transactions, 10 rupees. Using that transaction, we prepared our profit and loss account and balance sheet. But day one was too difficult, so we didn't prepare our cash flow statement that day. Today we will do that. But before that, you may remember in the previous session, I have already introduced the topic. In the previous session, I have already introduced the topic that when we prepare the cash flow statement, we prepare, cash flow statement is prepared into three major subcategories. We said cash flow from operating activities. You remember that? Then we said, okay, when you write it, today when you prepare the cash flow statement, you also can copy this. इसके बाद you have to keep 3-4 lines का gap. Then you give cash flow from
financing.
No, financing बाद में करेंगे. Investing करेंगे. Investing activities. Again give a gap of 3-4 lines. Finally CF, cash flow from financing activities. And how can I summarize what I said in the last class? The simplest summary is this. The day-to-day operations of the business. The day-to-day. Paying for expenses, collecting revenues, paying to creditors generally. Paying to creditors for our normal sales, normal purchase and sales, right? Collecting from debtors. They are all operating activities of the business. They are all operating activities of the business. What was financing activity? Our business, the total capital requirement was, in the previous session we said 100. Out of 100, we are structuring our finances in a manner that 60 will be equity and 40 will be debt. This is called a capital structure decision or a financing decision. This is called as, so this is part of financing activities, right? And what is investing activity? Having collected 100 rupees, right? 60 through equity and 40 through debt. We decided to invest 90 rupees in our land, building, equipments, machineries, laptops, all those things, and buying all the fixed assets. So that was the investing activity, right? So this was the, so since these are three major activities, therefore cash flow statements also shows how much cash flow we earned from each of these three activities, so that we understand where do we stand, whether we are, because if we are not making cash from operating activities, that is the biggest mistake you can have. Are you seeing it? These are more, this is something that's happening on a day-to-day basis. Operating activities is something that's happening on a day-to-day basis. Investing activities are not day-to-day. They happen a few times in a year, but they are not happening on a day-to-day basis, right? You don't buy a machinery every single day. When you buy, you can buy another equipment, you can buy some land, but you don't buy this daily, right? You do it few times in a year. Cash flow from financing activities are again not done daily. You don't issue shares daily. You don't issue shares daily, right? So these are things that are more irregular in nature. Operating activities is happening on a day-to-day basis. Daily you are selling, daily you are buying, collecting payments and all, right? So this in some ways is relatively more important. You can have from investing activities, you can have negative cash flow. And remember when we said cash flow means both cash inflow, cash came in, or cash outflow. So cash flow means both cash inflow, that cash came in, or cash outflow, that cash went out. And from an investing activity, cash can go out, but there is nothing to be worried, because we know when we have invested in machinery and equipment, then the intention is it will generate revenues in future, right? So having a negative balance from cash from investing activities is to be expected. हाँ उसमें नेगेटिव होगा ही, and it is reflective of the fact कि in future we will have higher sales, right? But having a negative here is possible, but this is something that one has to be very, very careful about. Are you getting what I am saying? And financing activities, see, if you are issuing shares or bonds, then it will have a positive number here. But if you are redeeming them, then it will have a negative number. If you are for your interest paid to your debts or your dividend paid to your shareholders, you will go to the financing activity point, right? Because this is a result of your financing decision. This is a result of your decision to have this much of equity and this much of it, right? So, and as you can see, just a statement of income connects the two balance sheets, right? With an opening balance sheet, even in your examination by bills, you were given an opening balance sheet. Then you were asked to prepare a profit and loss account. And then based on opening balance sheet plus your profit and loss account, you arrived at your, of course you did your transaction analysis. So you arrived at your closing balance sheet. You remember? So this statement of income for the year ending 31st December 2011 is connecting the two balance sheets. Similarly, the statement of cash flows is also connecting the two balance sheets. And if you remember the previous session, you remember I showed that table, profit and loss account positive, cash flow positive, that is the best case scenario. And then we had in some cases minus, this is the worst case scenario. Then we can have 1 plus 1 minus 1, another minus, another plus, and so on. So, next. So yeah, so this just to remind you of, so we are now going back to day 1 because in next 25 minutes we have to prepare 25 minutes. Yeah, we have 25 minutes. So in next 25 minutes, today you have to redo your transaction analysis in 7 minutes or 8 minutes because there are only 8 transactions. In 2 to 3 minutes you have to prepare your profit and loss account. In 2 to 3 minutes you have to prepare your balance sheet, 2 minutes. And then next 10 minutes you have to prepare the cash flow statement for the first time. And why are you doing it again? Because then you can see the linkage between balance sheet, PL account, transaction analysis and cash flow statement because that completes the full picture. Do you understand that? On day 1 itself you have done it. So assets equal to liabilities plus equity we already know from day 1. Let's go to the next slide. So everyone please start preparing again. So this is not to be copied. This is what you are given. This is the question. Now after giving this question, what I am saying is, based on this question, now first prepare the transaction analysis table, then prepare the profit and loss account. So transaction analysis table in 7 minutes. There are only 8 transactions. Then you prepare the PL account in 2 to 3 minutes, balance sheet in 2 minutes, and finally the cash flow statement in the last 10 minutes. Clear or clear? So here is the table, Sam Roti open business and provided in the following. Everyone please prepare. So this table you can take the headers, assets equal to liabilities plus equity, and under assets you can have 3 columns, cash, supplies and equipment. The only important thing to remember is supplies in this question is no, not inventory, is an asset, fixed asset. It's used in the form of an asset, right? Not inventory. So please start preparing. This is simple, right? This is day 1. So invested 8,000 in business in exchange for common stock. Common stock, you know, share capital. So cash came in, cash is up, share capital or common stock is up 8,000. Just to remind you, once the transaction analysis is done, we already know that this part, you remember day 1, this part is your profit and loss account. 3,000 minus 800 minus 2,000, 2,000 is your net profit. 2000 net profit, 1500 is distributed as dividend, so 500 is retained earnings. This part represents your retained earnings statement. And finally, from day one, we also remember assets equal to liabilities plus equity. These are assets, this is liability, and this is equity. So the last row represents the balance sheet. Day one, nothing special. The last row represents your balance sheet. Done? So prepare the PL account and the balance sheet now. Just change the slide. That's it. So this is the PL account. What does PL account say? Service revenue 3000, salary 800, rent 200, total expense 1000, net income 3000 minus 1000, 2000. And the opening balance, because we started a new business, the opening balance of retained earning is 0. Add net income for the period 2000 less dividend 1500, we are left with 5. Right? Okay, done. So now go back to the now prepare the balance sheet. PL account is done, retained earnings is done. Let's go to the balance sheet. So balance sheet, if you see on top, we have written the headers, and this is the last row, the balancing figure row. This is the last row of the balancing figure row. Cash was 7000, supplies 500, equipment 4000, total of assets 11500, accounts payable 3000, common stock or share capital 8000, retained earnings 500. So this is how the balance sheet was balancing. All of you have prepared the balance sheet? Anyone who has not yet prepared the balance sheet? हो गया ना? Done? हो गया? मेरे को दिखाओ। ठीक है। मेरे से बैलेंस शीट हाँ हो गया। बैलेंस शीट is done? करना है ना? So yeah. Anyone who is not done the balance sheet? Everyone there? Yes. So let's go to cash flow statement. So how do we prepare the cash flow statement? There are two ways of preparing the cash flow statement. There are how many ways? Two ways. The first way is called as the direct method, and we will do the direct method today itself. The second method is called as indirect method. Under indirect method, we take the net profit and make some adjustments. We add back depreciation, we add some increases or decreases in working capital, and then we arrive at the final earnings. Right? So under the direct method, we just prepare the cash flow statement from all the transactions jointly. And under cash flow statement from direct method, what are the three headers that you have to give for your cash flow statement? This is how you will have to prepare it. Cash flow from operating activities, leave 4 lines. Cash flow from investing activities, leave 3-4 lines. Cash flow from financing activities, leave 3-4 lines. And once you have that space given, then you can just need to write which activity is operating, which is investing, and which is financing. And how do we do that? So this balance sheet is prepared by all. So let's go to our transaction analysis table. Yeah. So how do we prepare the cash flow statement? We are using the direct method approach. under direct method approach, we will just look at our cash account. We will list how much cash did we start with?
8,000.
What was the starting balance of cash?
Zero.
Zero. Because we started a new business. On 1st of September morning, the starting balance of cash was zero. Then the owner contributed 8,000 rupees as share capital, and so we had 8,000 rupees of cash. And in lieu of which we issued him shares, right? We sold shares to him of 8,000 rupees. So this 8,000, so now effectively under direct method, we have to look at all these transactions, the net impact of which is closing balance of 7,000 and opening balance of 0. So what is the, in the cash flow statement, here at the end first you classify this, the sum of all these activities must be how much? The sum of all these activities must be how much? 7,000, which is the closing balance of cash, because we started with 0 and ended with 7,000. So all these activities we have to now classify as operating activities, investing activities, or financing activities, right? So let's classify them as operating, investing, or financing. 8,000. So this is issuance of shares or sale of shares by company, right? How much? 8,000. Is this an operating activity?
No.
Is this an investing activity?
No.
It is a financing activity. We know it from our definition. Issuing shares, bonds, debentures, taking bank loans, these are all financing activities. So 8,000 goes under financing activities, issue of shares, right? Under financing activities, you will write issue of shares, then write plus 8,000. Under financing activities, write issue of shares, then write plus 8,000. Second is purchase 500 supplies for cash. And I have already clarified supplies here is to be seen as an asset. Like not as an expense but as an asset, right? So this is an asset. So this is when we invest in assets, is that an operating activity, financing activity, or an investing activity? It is an investing activity, right? When we invest in assets, how much did we invest? 500. So we will say purchase of assets with bracket supplies. How much? 500. So will it be plus 500 or minus 500? Minus 500. So we write purchase of supplies minus 500. We are all clear? And that will come under investing activities. The next is purchase 4,000 of equipment on account. On account means on credit. Did you pay cash? No. If we didn't pay cash, will it how? In which section of cash flow statement will it come? Nowhere. If we didn't pay cash, it will not come under cash flow statement. We may have bought an equipment. There is also another possibility. We buy an equipment and we say, "यार हम पैसे नहीं देंगे. I'll give you shares worth 4,000." Even then, you disclose it separately. It doesn't come under cash flow statement per se, but उसके अंदर एक नीचे note type आ जाएगा. If we have issued shares for, so we have, because there was no cash inflow or outflow, we will just give a note कि we have issued shares and you have read what it is.
Part of it if you buy with cash and the rest of it you buy with credit, how do you do it?
It's coming. This thing is only coming. Part of it cash, part is credit. Right. So in point number three, purchased equipment on account. So 4,000 on credit, no cash impact, and therefore nothing happens, right? What if we say we bought an equipment for 4,000 and paid 1,000 cash, and balance 3,000 is to be paid later, right? So in that case, purchase of equipment for 1,000. In that case, purchase of equipment for 1,000 will come under cash flow from investing activities, because we have invested in an equipment. But if we have not paid, so to the extent cash was paid, it will come under investing activities. If cash was not paid, it will not come under investing activities. What is the fourth one? Received 3,000 cash for consulting services. Received 3,000 cash for consulting services. Is this a normal business operation? Generating revenue? Yes. It's a normal business operation. So is it an investing activity or a financing activity? Operating. It's an operating. It's a cash flow from operations. So sale of services or revenue from consulting services. How much did we get? Plus 3,000. Plus 3,000. Please also ensure in cash flow statement this plus and minus is important. In cash flow statement, plus and minus is important because plus represents cash inflow and minus represents cash outflow, and the difference of the two will represent the balance. Paid salaries of 800. This is a daily operation of the business. So cash flow from operating activities minus 800. Salaries is clear? Same with rent. Paid rent 200. It's a normal business operation, normal business activity. It comes under cash flow from operating activities. So we say paid for rent, how much? 200. So it's minus 200. So under operating activities, these are coming as minus 800, minus 200. So cash inflow you will designate with plus, cash outflow you will designate with minus, and therefore this is how you will do it. Right? Paid, this is important, paid 1,000 owed to a creditor. Normally, just hold on, normally when you pay to a creditor for a normal purchase and you are in this business of buying, say, pants and shirts. You bought some pants and shirts from somebody and you paid to him after 10-15 days. Normally it will be a cash flow from operating activities. Normally it will be a cash flow from operating activities. But in this particular question, as we can see from the context, the 1,000 owed to a creditor, there is only one creditor, and that creditor is on account of purchase of 4,000 of equipment on account. There is only one person to whom we pay because we have just started the business on 1st of September, right? So it is absolutely clear from this context that the 1,000 owed to a creditor is actually paid 1,000 on account of purchase of equipment. Paid. From the context, it is absolutely clear. From the context, it is absolutely clear that this 1,000 is on account of equipment, and that equipment is not an operating activity; it is an investing activity. So it will go under investing. So you are putting it in the investing activity. No? It will go under investing activity minus 1,000. Like basically paid for purchase of equipment 1,000 minus 1,000. Finally paid dividend of 1,500 in cash to Sanjay, the shareholder. So 1,500 rupees is gone out. Is payment of dividend a normal business operation? No. Payment of dividend is not a normal business operation. Why? Normal business operation, you sell and buy goods. You generate profits. वहाँ पर normal business operation ends. Normal business operation ends there. What is dividend? Dividend is distribution of profit. Dividend is distribution of profit. And why is dividend being paid? Dividend is being paid to equity shareholder because the equity shareholder contributed capital. Dividend is being paid to equity shareholder or the shareholder because the person contributed capital. Since dividend is just like paid में फल, it's like fruits of the tree. Dividend is just like fruits of the tree. And since the person, we had issued share capital worth 8,000, and for his contribution of 8,000, he has got dividend worth 1,500. Since that activity, number 1 was a financing activity, number 8 activity is an offshoot of that. एक पेड़ लगाया तो पेड़ में फल लग गए. You planted a seed, you planted a tree, and the tree bore fruits. So it is part of the same activity. It's not a separate activity. So it is coming under cash flow from financing activities. Are we all clear?
Yes.
Okay. So now let's go 2-3 slides later and show the cash flow. This one. So is this matching for all? Cash flow from operating activities, we had receipts was plus 3,000. Cash payments for expenses, they have kept 800 and 200. We have 1,000. So what is the net cash provided by operating activities? Plus 2,000. What is the cash flow from investing activities? By definition, investing activities will generate negative cash flow. By definition, investing activities almost always will generate negative cash flow. Purchase of supplies was purchase for equipment 500 and 1,000, so 1,500 negative. If cash flow provided by operating activities is negative, that is a matter of concern. If cash flow provided by operating activities is negative, कर क्या रहे हो? If you had borrowed money from your dad, started a business and you say, पापा पैसे नहीं है, he will ask ना कि कर क्या रहे हो? So if this is negative, this is a matter of concern. But cash flow from investing activities, by definition, when you set up a business for 90 crores, so you had to set up a factory, buy land, building, machineries, equipments. So cash flow from investing activities was expected to be negative. Cash flow from financing activities, in this case we have issued share capital 8,000, sale of common stock, sale of shares. So therefore it was 8,000 plus, but dividend was distributed minus 1,500. So we are net left with 6,500. So are you all checking that for your operating activities you are plus 2,000, investing activities minus 1,500, and financing activities plus 6,500, and the sum total of all three is 6,500 plus 2,000, 8,500 minus 1,500. Net increase in cash is 7,000, which is what is reflected in your cash balance also in the transaction analysis table. But this is not where you end. Then you write net increase in cash during the period is 7,000. Then at the end you write these two sentences. Everyone please write these two sentences at the end. One, net increase in cash shows 7,000 from this. And then you show that cash at the beginning was 0. Cash at the end is 7,000. And the difference of the two is also 7,000, which is also the same as net increase in cash. Are you seeing it?
Yes.
So you have to show in this same cash flow statement that net increase in cash from all these activities is 7,000. The cash at the beginning was 0, cash at the end was 7,000. The difference of the two is 7,000, and therefore this net increase in cash is getting matched. Are you getting it?
Yes.
Has everyone written the last 3 lines? That after all these activities, you still have to write these 3 lines. That the net increase in cash is 7,000 by 6,500 plus 2,000 plus 8,500 minus 1,500, so 7,000 plus. And then cash at beginning 0, cash at end 7,000. The difference of the two 7,000, which is telling you the net increase in cash. Is there anyone who has not understood? This is important. So this is called as the direct method of preparation of cash flow statement. What is the indirect method? Under indirect method, we will just take net profit, because we assume that almost all revenues and expenses are earned in cash. But there are, because your money is stuck in cash, because your money is stuck in not in inventories, in accounts receivable, then because of increase in working capital, the net profit is not the same as cash profit, right? So we have to make adjustment for the increase in working capital. Similarly, for depreciation, we have to make an adjustment, right? Are you getting it? Because depreciation expense was, you remember when I was showing the profit and loss account yesterday in the table form, we said EBITDA, then we showed less depreciation and amortization, then we showed EBIT. And the reason for showing EBITDA and EBIT separately is depreciation represents a non-cash expense. All other revenues and expenses were cash revenues and expenses, but depreciation represents a non-cash. So we have to make adjustment for depreciation, we have to make adjustment for increases or decreases in working capital, and then we arrive at adjusted numbers. So this we will do later. For today, I think this is sufficient. But everyone, every single person have you already prepared this? And is that okay? Now go to the other slide. Can everyone also no other PPT वो दूसरा वाला नहीं खत्म हो गया है we are done with the class so have you also checked because I saw when I went back I saw that some people had not done it correctly but your balance sheet also telling it this 100 bottles at 2 is your inventory 100 bottles at 10 is your inventory at 10 1000 and your cost on FIFO cost of goods sold is 3200 800 so this is 5000 this is 5800 so this should all tell you this is the correct answer and I am showing the correct answer in case your answer is not telling even now you still have time you still have a few minutes to get your correct answer